been a volunteer mentor and presenter for SCORE Buffalo Niagara for about 3 years and is currently an attorney with the firm of Andreozzi and Bluestein. Tiffany, thanks for offering our attendees the gift of your time and your expertise. We look forward to your presentation. The microphone and the controls are all yours now.
Okay, thank you very much for that introduction, and hello everybody. As she said, I'm an attorney. I'm a partner at Andreozzi Bluestein. We concentrate in tax controversy, and I've done this session a few times before for SCORE, and what I have found through the various sessions is that we have usually a broad range of people who are in various phases of their business plan and development. Some people who are just starting and are here for informational purposes. Some people who are actually already operating their businesses and need a more in-depth, sort of introduction to this the idea of taxes. And a lot of times people are afraid of taxes, afraid of the idea of taxes. And so generally what this is designed to do is give you sort of an idea about the things you should be thinking about when you have a business, a small business, sort of what your tax filing obligations might be, who you're reporting to, when and why. But also to help guide you and give you background information on how to keep your records and make sure that you have the information that you need in order to file appropriately, and also to endure an audit should that happen. One of the things that I do in my practice is I represent clients, individuals and businesses who either the IRS or New York State are either have put them under audit or sent them a tax due notice, or they got a notice that they didn't file a tax form that they were supposed to. And they contact us at my firm, and we help them through that process. And some of the things that I've learned over the years doing this for people is that a lot of times people enter into an entrepreneurial situation. They want to start a business. And as you probably know from your own experiences, you are focusing on your product, the name of your business, the market, your vendors, where you're going to get products, how you're going to keep inventory, how you're going to pay for it all. And a lot of times tax gets to be the last thing that people are considering and thinking about. But it's also really important. So I don't want you to be afraid of it. I don't want you to think that what you learn in here, some of it, there's a lot of information in here. Don't be intimidated by it, please. A lot of it won't even probably be something you're required to do, but I want to give a broad overview. Depending on your business structure and your type of business, it could change. So it's all in there, and you will notice that the slides are very dense in information, and that's partly because I want you to be able to have this as a resource. The slides can be made available to you. We've done that before, where if somebody was interested in having the slides, they could be made available to you, and through SCORE. And the reason is that some of you, it might all be brand new, and for others of you, you might already know this, but there are always there are also resources in here for you, to websites and information that might be useful after you've heard everything as we go. But I just want to congratulate you all for being here and for taking the time to sit through, a session in taxes at 6:30 at night, in the fall. So I'm happy to be here and help you guys through some of this stuff. I don't think that while I'm doing it, I'm going to see the chat. So I think that Nancy's going to be monitoring that for me. So if anybody has questions, you can ask in the middle. I'll be happy to try to answer you. And if I can't answer you, or I need to look something up or research it, I could always get back to you. You're more than welcome to reach out to me at Andreozzi Bluestein. You can Google search it, or I can give you my cell phone number, which is 716-913-0578. And I have no problem if you want to text me, just tell me you're from this SCORE session, or you can call, and I'm happy to help in any way I can, just to answer your questions, or at least guide you hopefully to the right resources. Speaking of resources, one of the this slide is at the beginning and the end, so it'll be up again. But one of the things that you should always know when you're getting started with these, with a business, is that you should rely on all possible resources. These are just some of the websites that you can find that have a lot of information, from nuts to bolts of what you may need when it comes to tax information. So the New York State Department of Taxation and Finance, very useful tool. They actually even have a link to starting your own business, and it has just a plethora of information in there that is useful to people depending on what type of business that they are interested in starting. IRS has a great website, and of course, New York State Department of State Division of Corporations, which is where you would go to file your articles of organization if you're forming an LLC, things like that. Then you have your New York State Business Express, which is where that link starting your business will, if you type in how to start a business in New York, you'll end up there. But don't be afraid, and actually you should. I would encourage all of you to consider getting attorneys and or accountants sort of in your toolbox, because a lot of times people will always, professionals are willing to help out a lot of times, get you started. But the reality is there's a lot of running around you can do on your own, and you should do on your own. But also don't forget that that's another avenue for you to get information and advice on getting started. It is better to ask ahead of time than to try to clean it up after the fact. As I was saying, in my role at work, I help small businesses when they are already getting notices from one of the tax agencies. And a lot of times, had they done their research up front, they wouldn't be needing my services. And so always try to give yourself the best options by investigating as much as you can through these resources. Okay, so you have certain things with taxes. You probably already know about income tax because you file your own personal income tax returns every year. But businesses also have income reporting and sometimes income tax requirements, both with the state and the Fed. New York State also has income taxes. It also has sales and use taxes. And both federal and state might have excise taxes. Sorry, my screen is blocked by this notice that the meeting is being recorded, so can't seem to get it off. I don't know if you guys can see that as well, and I'm sorry if it's blocking it. Excise taxes, those of you that may not know, are sometimes taxes that are included in the price of certain products. Usually it's tobacco, alcohol, tanning services, another thing. A lot of people might not even come into that, but I just put it on there to know that that is another thing that you may experience through federal, state, or local governments. The sales taxes, if you have any sale of certain tangible personal property or services, they're subject to sales tax according to New York State. Sometimes it's not extremely obvious what is subject to sales tax, so it's good to find out ahead of time if you can, by calling New York State, even if it's not obvious. And then a use tax is typically where you're going to see that is when somebody purchases a product outside of New York State but uses it in New York State. So they haven't paid their New York State sales tax because they bought it in another state, but are using it in New York State and may be subject to a use tax. And then, of course, if you end up having employees, you might see that there's additional tax requirements and reporting requirements that you have, and that would be what sometimes called employer taxes or withholding taxes. Both the feds and the states have these types of taxes. So if you have employees for your business, you're also going to have additional tax reporting and tax requirements. And whether or not what your tax filing requirements are, it depends on what type of business structure you set up. And I'm going to go over some of the basics with business structures. I'm sure if you've attended many of the other SCORE sessions, they have great workshops on business structures and trying to pick the right entity for your business structure for your business. So I'm not going to get into a deep detail on it, but I'm going to separate these out because it's important, because your tax reporting and tax paying obligations change depending to some extent on the type of business structure you have. And a lot of times what happens when you sit through these meetings, you're trying to decide what's the best business plan for me. You're looking for liability, limited liability. You're looking for other things. You should always be also thinking about the tax perspective of which business entity is better for you as well. But you have your basics. You've got a sole proprietorship. There's partnerships and corporation. A corporation can either be a C corporation or S corporation. And then you have limited liability companies. There's others, but these are the main ones that you're typically going to come into contact with. As you probably know, the sole proprietorship, it's a business owned by one person. It's the simplest and most common form of small business. You don't have to do anything to set it up. Like you don't have to ask New York State to be a sole proprietorship. You start your business, and as long as you have your licenses that are required, you don't have to set up the business. It's not a separate legal entity from the owner. So the owner is the business is the owner. And that means that the owner is personally liable for the debts and obligations of the business. Okay. The business's profits and its losses are then reported on the individual's personal income tax return. And there's only one level of taxation. So it's just the money comes in and you have expenses, and whatever your sort of profits are get reported on your personal return. That's it. You do not have to get a federal employer identification number, but to own a sole proprietorship, they would just use your social security number in your reporting. It's not done in your personal return. However, I would still recommend getting an EIN, because you probably don't want to put your social security number on everything anyways. But if you have employees, if your business needs to hire employees, you definitely need an EIN, just so you know, keep that in mind. Getting an employer identification number through IRS, you can go to irs.gov, you can apply online, and you'll have it immediately. So it's not a difficult process, and it does not cost anything. All right, a partnership. It's just a business where there's more than one owner. So if it's two or three of you that want to start a business, you're automatically a partnership. Again, you don't really have to do anything to set it up. You don't have to ask New York State if you can be a partnership. You just are once you start running a business. Partnerships are a little bit different because they have a partnership return that does get filed, but it's not a tax return in the same sense that you would think, because you don't owe taxes when you file a 1065. Instead, the 1065 form is what reports to IRS what the income and expenses of the business are. And then that income, though, flows through to the partners, and it is reported on their individual tax return, Form 1040. Again, there's only one level of taxation. It's really at the owner level, not at the partnership level. A partnership, however, does need to obtain identification number. There is sometimes, I'm just trying to think. Yeah, even if you don't have them fast or going too fast, please feel free to say something, stop me. I don't really have, like I said, I can't see the chats while I'm doing this. So if Nancy wants to pop in and just let me know if anybody has questions or if you're asking me to slow down. I also I know this area pretty well, so I sometimes use terminology and lingo, and I talk about the form numbers as if you know what they are. Maybe you do, but if you don't and you have questions, need clarifications, please feel free to stop me and slow me down. Corporations are a separate legal entity, and that's what you'd normally see you hear about corporations, and the owners of a corporation are its shareholders. Okay, and the shareholders form corporations in order to give themselves personal limited liability, so that the debts of the business and the obligations of the business are not fallen onto the shareholders. The shareholders are not personally liable for the debts of the business, typically. A corporation is formed by filing a certificate of incorporation with the state of New York. The corporation, of course, has to get an EIN, and they are by default what's called C corporations under the Internal Revenue Code. A lot of times people will say a C corp. What actually a C corp really is, it's not a separate entity. Instead, it's an election. It's an election that the C corporation can make in order to be taxed differently. The differences between a C corp and an S corp quickly we'll go over. Yeah.
Do you want to take a question?
Sure.
The question came, so do you still pay taxes if you hire freelancers? So I'm wondering if they mean, you know, if you pay employment taxes or if you pay, I don't know, I'm kind of confused by the question.
Okay, I'm seeing it now. If you're a sole proprietor, do you need to pay taxes if you hire freelancers? Or are you saying if you were hired as a freelancer?
That's what I tried.
So you asked, okay, good. Well, I'll answer both the questions. So if you are a sole proprietor and you hire freelance people, you've got to be very careful about that, because IRS is going to typically want your people that work for the business to be employees, because then they get, you know, they get the taxes through withholdings and everything else. If you have a person that you're hiring for a particular job, you know, let's just say you own a magazine and you're hiring somebody to write a column. You're not telling them what to write in the column. You're not telling them when to work or when not to work. They just have to get you this written, you know, report that you get to publish. If that person is considered an independent contractor, then they would actually get a 1099. So you're not doing any withholding, and we'll get into the employment tax side of it a little bit later, but you're not doing that. And on the form, do we have to file for all? Okay. Yeah, so what happens with, I'm assuming when you are asking about whether or not you pay taxes on the independent contractor, you're not paying the employment taxes. You're just giving them a 1099. If you pay them over $600 in a year period, you have to send them a 1099 form. That reports all the money that you've given them, and then they have an obligation to report it on their personal income tax return and pay their own taxes, and then they'd have their own employment taxes. And we'll talk about that a little bit later when we get to the employment tax section. So if it doesn't get more clear after that, please feel free to ask that question again. Anything else, Nancy, before I go on?
No, that was it. So that's good. Thank you. I think that's all we have right now.
Okay. So when you have a C corporation, they're taxed at the entity level, and they're also taxed at the shareholder level. You'll hear this all the time about double taxation. It's the one of the few times in the Internal Revenue Code where there is, you know, they are in fact trying to double tax you on something. And it is a more expensive way in some ways. So larger corporations, you're going to see this with, you're going to see where it's getting, the corporation itself pays an income tax, they file Form 1120. If they have enough profit that they are distributing out to shareholders, making a distribution to shareholders, the shareholders then report that distribution on their Form 1040, their own individual. So it's possible that the profits from the corporation are getting taxed twice, because they're getting taxed when they're made and they're getting taxed when they're paid to a shareholder. And if you're the shareholder and you own your own C Corp, essentially that means it's getting taxed twice on you. It's also subject to the state franchise tax. An S corporation, on the other hand, it's an election that you make, and it only has one level of taxation. You still file what's called an information return. So you'll hear me sometimes say an information return or a tax return. And I say it that way to clarify what's happening here. An information return is a return where you're reporting income and expenses of the business, but the tax isn't paid with that form. So what would happen is for an S corp, they'd file an 1120S, and we get into more detail on this later. They report the gains and losses of the corporation, and then that passes through to the shareholders, and the shareholders are reporting their share of the profits on their own individual tax return. And S corps are also subject to the state franchise. Sorry, it's hard for me to find my next arrow here. A limited liability company is a separate legal entity from the owners. It is formed by filing articles of organization instead of articles of incorporation. But it's filed with New York State as well. You have to go and let them know that you're doing this. There's a publication requirement that goes with it. And actually filing the articles of organization is not all that expensive. I think that it's like $120 to do it. The publication fees that are required tend to be your larger expense on that, sometime depending on where you publish it. But in an LLC, the owners are called members, not shareholders, although you'll hear people use those words interchangeably. They're really called members. And each member of the LLC would have limited liability for the contractual obligations of the company. Okay. And so it sort of is similar to in liability protection as a corporation would be. A single member LLC, which means you only have one owner. There's one member, that's a single member LLC. That is treated for tax purposes. It just defaults to sole proprietorship. So it's getting reported the exact same way as if you had a sole proprietorship for tax purposes, which means that you're reporting the business's income and losses on your Schedule C of your 1040. A multi-member LLC is just by default a partnership, and it follows the partnership rule. And then an LLC, though, can elect to be taxed as a corporation, which means if it's a C corporation, it's getting taxed on 2 levels, and it files the 1120, and then the shareholders would also report their distributions. And if you do elect to be taxed as a corporation, you can also elect to be an S corporation, which would mean you would follow the S corporate rules. So business taxes in general, you're going to see things. And the reason I start here is sort of like a big picture, because again, in my job, I see a lot of people who are starting their businesses, focusing on their business as they should, who aren't even aware of some of the taxes they are required to file and when. And sometimes they will rely on professionals, and sometimes they get bad advice. And so it's really important that you at least have an idea that these things are out there. And so you know to ask the right questions if from your advisement team, your toolbox team there to help you out and make sure that everything is getting done when it's supposed to, how it's supposed to. And so I kind of just go over all of them. You've got, of course, income tax, income reporting, and sometimes income tax businesses pay. There's also, if you have employees, there might be Social Security and Medicare taxes. If you are self-employed, you would have self-employment taxes. Self-employment taxes are basically the Social Security and Medicare that you would be paying if you were being withheld on in a normal employee situation. There's income tax withholding. It's not really a tax you pay, but it's tax that your employees have paid and you're required to turn over. And there's also Social Security and Medicare withholding. There's, which again is for your employees. There's a federal unemployment tax, also called the FUTA tax. It's only paid by the employer. And then sometimes there may be excise tax depending on your business. And I just want to make clear, and I say this, I think in the next 2 slides, that every business has a tax return filing obligation, whether or not it makes a profit. If you start your business and you have a loss for the first 2 or 3 years, you're still supposed to file that return. You would file it and report all your gross income, and then you would end up with reporting any of your expenses, and those get taken off, and you'd show a loss, and you could even carry that forward. So you want to make sure that you're filing, but there's always at least a reporting obligation. And we'll get into that, especially when it comes to things like sales tax later on. So for the state, general business taxes, not every business has, but you'd have income reporting and sometimes income tax obligations. You have your franchise, you may have a franchise tax obligation, a sales or use tax obligation, and then you'd have withholding tax requirements if you have employees. And again, whether or not you make a profit, even if you have a business where you have gone and gotten a certificate of authority because you are selling some items that are taxable in New York State, and let's say you have a whole quarter where you didn't sell one item that's taxable, you only sold items that were non-taxable, you would still have to file a sales tax return. As soon as you have your certificate of authority, you become obligated to file that sales tax return. We'll get into that a little bit more in detail too later. So federal taxes for a sole proprietorship. And I get kind of in detail here because I start and then later I fly through these. If I'm going too fast, please feel free to interrupt through the chat, and Nancy will let me know to stop or slow down. So a sole proprietorship would have an income tax. It's reported again on the individual's Form 1040. So when they file their tax return on their regular tax return season, they'll have a Schedule C, and on that Schedule C, they will report all the income and expenses of the business, and they'll either have a profit or a loss, and that will be reported through that. There would also potentially be the self-employment tax. This self-employment tax is information gets reported to the Social Security Administration, and that way they know what you're making, whatever, and you're paying towards that as well. You probably have estimated taxes. If you estimated taxes in a situation where you run your own business, it's sort of like withholding that you would get from your regular paycheck. Every time you get paid, some money is already going to IRS and to New York State in your withholding. Well, if you work for yourself and you're getting paid the gross receipts, like if you are that independent contractor and you're putting a roof on somebody's house and they're paying you $20,000 to do it, you're not paying any portion of that over in taxes until the end of the year. And so IRS, New York State, they don't really like that because you know how easy it is to spend your money when it's in your pocket and how hard it is to find it when the tax man comes around. So they do have requirements for estimated taxes, which is essentially like your withholding if you want to think about it sort of theoretically. So if you are a sole proprietorship, like I said, and you have employees, and this doesn't count again for independent contractors. Independent contractors, I don't talk about independent contractors on here, but if you have people where they would be considered independent contractors, you would give them a 1099, and they'd have to pay their own taxes. But bearing in mind, again, that IRS could come in and disagree with you that they're independent contractors. A lot of times people will say, oh, this receptionist at my tanning salon, she's really an independent contractor because I don't tell her when to come in. But so she answers the phone, identifies as working for you. You pay her, on a weekly basis or out by the hour, and that's not an independent contractor. And IRS can come in and change their classification. So just want to make sure you know that as well. So Social Security and Medicare taxes, if you have employees and income tax withholdings, those are reported on the Form 941. It is filed quarterly, and it's used to report the income taxes, the Social Security or the Medicare taxes that you withheld from the employee's paychecks, and also used to pay the employer portion of the Social Security Medicare tax. So this gets kind of complicated. I want to make sure you understand. When you have your W-2, you can look at it and you'll see that you have federal tax withholdings, you'll have Social Security, and you have Medicare. Those are already withheld from your paycheck. You as an employee have to pay, you pay your income tax, you pay Social Security, you pay Medicare, but you're not sending it to IRS, your employer is, because they've collected it from your pay. And they have an obligation to pay it over to IRS for you. At the same time, the employer pays 50% of the Social Security tax and 50% of the Medicare tax, and they have to pay that. And that also gets paid by them on the 941. So what they're sending to IRS is the employer portion plus what they withheld from the employees. And that's kind of how that works. It does get a little confusing, but just know that it's on 941. That's the form that you report all of that on. If you have employees, I would recommend getting some form of payroll company to assist you. Unless your payroll is extremely easy, you have maybe 1 or 2 employees, you can probably get an accountant to help you do that. But if you have any more than a handful of people, I would recommend getting a payroll company. They usually will take care of all of that for you. But again, I would make sure that's in your contract, because sometimes it's not. So you want to make sure that they are also going to be filing your Form 941s and your Form 940s, which are the next one. That's the federal unemployment tax. That's only paid by the employer. The FUTA tax, it's filed on Form 940. It's done once a year, annually, on January 31st. And then if you have excise taxes, are usually paid when you purchase an item. It's not something you necessarily file. Federal taxes for partnerships. So a partnership, like I said before, has to file an annual information return. And they report on that information return all of their income, their deductions, the gains, losses, everything from its operations. But it doesn't actually pay the tax. Instead, any amount of profit or losses of the partnership will pass through to the partners. And each partner is going to include that income or loss on their individual income tax return. So what happens is that Form 1065 is due on March 15th, a month earlier. And I use these dates for if it's a calendar year business, just so you know, it might change if it's on a fiscal year. But the Form 1065 is due on March 15th. And with that, the partnership is supposed to issue what's called a K1 to its partners. And on that K1 will show each partner what their pro rata share of the profits or losses are. And that's how that partner will take that information from the K1 and they will file their Form 1040 individual tax return, and it gets reported on Schedule E. That's where they would report that. And if the partnership has employees, of course, they have to also file the 941 and the 940s. 941s are quarterly, 940s are annually. Partners individually on their returns would file, like I said, the 1040 with Schedule E, reporting the income that they got from the K1 and their self-employment tax and estimated taxes, likely. For federal taxes for corporations, again, C corporations are separate tax-paying entities. They earn the income, they pay expenses, they pay their taxes, and they may or may not distribute profits to the shareholders. So again, that's the double taxation issue. And when a C corporation is paying out a distribution to the shareholders, it doesn't get to claim that as a deduction on their tax return because they've already paid the tax on the profits. They don't get to say, oh, but I paid it out to somebody else. They don't. And the shareholders can't deduct any loss of the corporation. So if the corporation has a loss, unlike a partnership, if a partnership has a loss and it passes through to one of the partners or all the partners, like let's say somebody made $50,000 a year in income separate from the partnership, but they had $20,000 in losses from their partnership business, they would only end up getting taxed on, these are very rough descriptions, but they would only get, I lost track of my numbers. I think it was 50,000. I said they had of other income, 20,000 in losses from the partnership. They'd really only get taxed on $30,000 because they get the benefit of the losses of the partnership on their personal income tax return. That does not happen with a C corporation. C corporation shareholders don't get the losses. They wouldn't get a distribution, but they don't get to reduce their income tax liability by the losses of the corporation. Let's see. A C corporation files its income tax return, which is an income tax return, on Form 1120, and that's due April 15th. They would also have estimated taxes, employment taxes, potentially excise taxes. And bear in mind that, of course, I'm giving you these dates, but all of them could be subject to an extension. You can make a request for an extension. A lot of businesses don't file on time because they just can't get all the information they need in time, so they'll file an extension to file. Okay. For S corporations, an S corporation, again, they're corporations that elect for the pass-through taxation. So they actually file, an S corporation files an 1120S, which is an information return, which then they report the information on whatever tax would flow through to the shareholders, and the shareholders report that on their Schedule E. So there's no double taxation. And I put this little last point in here just because to get an S corporation, it's kind of complicated. You have to follow certain rules. You have to qualify. You can't have certain things. And when you're looking it up, whether or not you would qualify to make an S election, which a lot of businesses would, but once you get that S election, you can lose it by bringing in a shareholder or going that you shouldn't have in order to be in the, to qualify for an S election. Things like that can blow the S election. You'll hear people talk about them. The last thing you should know what would blow your S election. Make sure you're not doing it, because then you end up with the double taxation and not having this S election, which could change. You might lose it after the fact, and then you have to go through and some of your business ideas and planning had revolves around you thinking you were going to be an S corporation. I only mention it just again so it's out there and you're aware that could happen. You can lose it even once you've been given it. So again, for S corporations, they have the income for their income tax. They just are providing information on an 1120S. They don't pay. The corporation doesn't pay the tax on the 1120S. Instead, it gets reported on the Form 1040 Schedule E using the K1 that the S corp has to give out to the shareholders sometime after March 15th. Again, the 1120S is due March 15, 1 month before the regular tax filing deadline for individuals. For an LLC, it gets a little trickier, and so you're going to hear some repetition here, but generally an LLC is going to be treated either as a corporation, a partnership, or as part of the owner's tax return. Like, again, if it's a single member LLC, it's really for tax purposes what they call a disregarded entity, which means it's not an entity at all. It is the owner. It is the member, and it gets reported on the member. All the income of the business and expenses gets reported on the member's Schedule C. So a single member LLC, again, is going to be treated as a disregarded entity. If unless it files Form 8832 and elects to be taxed as a corporation. Remember, I said that LLCs will either be a sole proprietorship if it's single member, a partnership if there's more than one member, or they can elect to be treated as, for tax purposes, as a corporation, in which case then they become taxed like a corporation. So same with the two, so same thing, single member, you file 8832, elect to be treated as a corporation, or it's going to be treated as a sole proprietorship. 2 or more member LLC is going to automatically be treated as a partnership unless they file Form 8832 and elect to be treated as a corporation. Once you've elected to be treated as a corporation, you can also elect to be treated as an S corporation. So you're either a single member following sole proprietorship rules, or a multi-member following partnership rules, or you've elected to be treated as a corporation, and then you file corporation tax filing rules. If you're an LLC that's elected to be treated as an S corp, you're going to follow S corp rules. And you're going to see a lot more people are doing LLCs just because it's such an easy formation, especially if you only have a handful of members. You'll see a lot of that. It gives you a lot of flexibility on how you want to be treated in the tax world, but also gives you that limited liability for the owners so that they aren't held personally responsible for the debts and obligations of the business. So for the feds, they love penalties. They have a lot of civil penalties where if you don't do something right, you can be penalized, and sometimes the penalties can be more than your tax might have been at the time. So if you fail to file an income tax return or an information return, if you file it late, you can be subject to a penalty. The penalties are usually based on the percent of the tax that would have been due. If you have a failure to file, it's usually a chunk amount. So it could be 200 all the way up to, over $10,000 for a failure to file an information return. If you fail to pay, or you pay, you continue to pay late, you can get penalties for that. You have penalties for filing a frivolous return. If there's just no basis for the position you've taken on a return, there's a penalty for that. And then you could have accuracy related penalties or negligence penalties, where you filed the return and you filed it on time and you paid on time, but it's wrong in some substantial way. If you made an understatement of income or gross receipts, or you have made a misstatement of basis, you could end up with one of those penalties. Just because they put them on doesn't mean you're stuck with them. You can fight them, and that's what I do most of the time on my job. Is I figure out a way to get people out of their penalties that get imposed for various reasons. Sometimes on the merits, sometimes for reasonable cause, or first-time penalty abatement. Those are options. In red here, and I'm going to talk about this probably a little bit later, but generally I want you to understand about trust fund recovery penalties, because this is the one that I see a lot with small businesses that can lead to such sort of a snowballing effect. And I keep talking about all this limited liability that these business entities have and provide to the owners. One area where you are not provided with this personal liability protection is in the trust fund recovery penalty area. This could happen, and I'm just going to use, for example, probably the main example that I see most of the time is for the 941, the employment taxes. You are, as I said, on the 941 form, you are every time you pay somebody, you're withholding the income tax for them. You're withholding the amount they would pay for their unemployment or their Social Security, and Medicare. You're withholding that money. And as a business, you have an obligation to turn that money over to the IRS. And if you don't do that, the IRS can come in and hold you personally liable. If you're the owner of the business, an officer or a director, or even if you're the person working in the office that makes a decision to, instead of turning that money over that they've held back from the employees, to turn that over to the IRS and instead say, we need to pay the rent, we need to put the lights on, we need to pay next week's payroll, we're not going to pay this over to the IRS. You could be personally liable for those taxes that weren't paid over. The trust fund recovery penalty is for the employee portion of that obligation, and it is only paid once. So if the business does end up paying their employment taxes, then the individual, it reduces their liability by the same amount of it getting paid. But just be aware that they can come after the individual owners personally for this penalty. So it's very important that you don't get behind, or you don't use that money to pay anything other than sending it into IRS, because it's not the business's money. It's actually the employee's money that was held by the business, intended to be turned over. It's held in trust by the business, intended to be paid over to a taxing authority. So that's kind of one of the things I want to make sure that you understand, because that's an area that people tend to get themselves into trouble with. And the last thing I want is for that to happen to you guys. There's also criminal penalties, tax evasion, willful failure to file a return, things like that. People make mistakes all the time, and they don't file a return on time, or they don't file at all because they get they're not sure how to report something. They maybe had a transaction and they're not sure how it gets reported, and so sometimes they have an issue with their accountant, things outside of their control. They get very sick. They have a death in the family. Yeah, sometimes that stuff happens, and so you're not always subject to a criminal penalty when these things happen. But you have to have intent, to evade taxes, or intent, willful purpose to not file a return or not pay your taxes before it gets to criminal. But just be aware that there are penalties out there, and so you don't want to get in. I see a lot of times what happens is people get overwhelmed, or they can't pay their taxes, and so they just don't file. They don't call IRS to ask for help or any of those things, or get attorneys or CPAs to help them. And they just bury their head in the sand, and the problem gets worse and worse and worse and snowballs, and they can't get themselves out of it. And sometimes they lose their business over it. And that's the last thing I'd want you I keep telling you it's not scary, but it can be scary if you bury your head. Just know that these are out there, but it's a big difference between accidentally not filing something and intentionally not filing. In New York State, similar idea. You have income taxes, but in New York State, you also have sales tax. Sales tax is applied to certain tangible products. So I know you notice this when you go to the grocery store, you probably see your milk is not taxed, but candy is. You see that your bakery goods are not taxed, but a bottled water is. And it maybe doesn't make sense why something is taxed and why it's not. That's why it's very important to make sure you understand what is subject to sales tax. You can find that out on the New York State Department of Tax and Finance website. The website is at the beginning and the end of the slides here. They give you a whole list. It's not always easy. I used to own a kettle corn business, and kettle corn, for whatever reason, is not taxable. It's subject to sales tax. But caramel corn is, and so it's one of those strange things that sometimes it doesn't always make sense. So it's important that you know if what you're selling is going to be required to collect sales tax for. Then there's the withholding tax, same idea with New York State. So it's your New York State income tax, withholding, and employment taxes. And then there's also franchise tax in New York State for certain businesses. So a sole proprietorship, again, is just reported on their individual income tax return, which in New York, usually for your full year residents are going to be your IT 201. For partnerships, again, it flows through to the partnership. There is a partnership return. Again, it's an information return, but the information from that gets reported to each partner through, so they know what their share of the profits are, and they can report that on their individual income tax return.
Hey, Tiffany.
Yep.
Hi, here's a question from Michael. Does a membership fee to a private club require sales tax?
Does a membership fee to a private club require sales tax? Not that I'm aware of, but I would want to look that up specifically because, again, New York State does a really strange division of what is and what isn't taxable, and I haven't had to look that up specifically, so I could look that up, and you can text me or call me, and I can get you an answer by tomorrow to that.
Tiffany, what is your cell number? Someone asked that I put it in the chat box. Would that be all right?
That's fine. So it's 716-913-0578.
Thank you.
Oh, you're welcome. And so for New York State with corporations, a domestic corporation, there's a difference. So if it's a domestic corporation, it's a corporation that it has been incorporated on the laws of New York State. So you formed it with the Secretary of State in New York. Whereas a foreign corporation could be a corporation that was formed outside of the United States, but it's also any corporation that has been formed in another state. So if you for whatever reason, want to form a Delaware corporation, and you want to do business in New York, you have to get permission from New York to do business here, just so you know, and you would be considered a foreign corporation. But corporations typically file their franchise tax returns on an annual basis. S corporations, if you have made the S election federally, you're probably going to make it for the state, but it is a separate election. You have to do it for both of them. For LLCs, again, for however an LLC is treated on the federal side, it's going to be treated that way on the New York side. So an LLC that's treated as a partnership for federal purposes will be treated as partnership for New York State tax. Same thing with corporations, although you will, like I said, have to make a separate S election in New York. If you choose to make the S election federally, you'd want to do it again for New York. For sales tax, New York State sales tax, if you think that you may be selling products or services that may be subject to sales tax, if
Tiffany, you've frozen and we can't hear you.
Are going to be receiving exemption on behalf of New York State and over. Oh, you can't hear me? Is that
It's better now. Yep.
Okay. I don't know where you stopped hearing me, but I was talking about certificate of authority. So I apologize if I'm repeating myself, but I want to make sure you hear this part. If you think you're going to sell goods or services that are subject to New York State sales tax, or you're going to receive exemption certificates, you need a certificate of authority from New York State. The certificate of authority is what New York State gives you to allow you to collect sales tax on their behalf and then pay it over to them. This is another one of those trust type taxes considered, because you are actually holding sales tax for New York State and paying it back over to them. If you do not pay it back over to New York State, they consider it theft. So be very careful that you're not spending that money on anything else. You should be saving it separately if you're collecting sales tax. You turn it over to New York State. The certificate of authority proves that you're registered for sales tax purposes. You are supposed to apply for this with at least 20 days before you expect to do any business where you're collecting, selling sales tax subject products or services. If you are on taxable sales before you have that certificate of authority, you can face penalties, and they're pretty severe, $10,000 for it. You don't want to face those penalties, so get it. Now, one of the things is, again, applying for the certificate of authority, you can do it online at the New York State website. It's free and it's very quick to get. And so I would, if you know for sure you're getting close to opening your doors for business, I would get it. The only caveat to that, I would say, is that once you get the certificate of authority, New York State is going to be looking for that sales tax return. Everybody is obligated to start filing sales tax return on a quarterly basis, even if you have no sales at all during that period. It's easy. It's a web file form. You go on and you just report that you had no sales or you had no taxable sales. And so there's no tax to you, but you have to file it. If you don't file it, they are going to send you a letter saying they're penalizing you. And if you don't file by a certain time, there'll be another penalty. It'll increase. So you want to make sure that you're doing that. You can easily get a bookkeeper or an accountant to help you with sales tax returns if you're not comfortable using the computer, but New York generally demands that everybody web file nowadays. And again, you would start being a quarterly filer, but if you don't have a certain amount of sales tax on a regular basis, New York State will notify you that it's okay to file as an annual filer. If you're an annual filer, you would file on March 20th. If you're a quarterly filer, those dates are there. But I want to make sure you understand that a sales tax quarter is not the same as the quarters you're going to see for 941s. Usually the quarters are divided January, February, March, April, May, June, like that. But sales tax is different. The first quarter includes December of the year before, and then January and February. It's paid in March 20th. And then March, April, May gets paid on June, and so on and so forth. It gets a little confusing, and I just want to make sure you know that up front, that it's not a calendar year quarter.
Excuse me,
and so
Tiffany?
if you're, yeah.
Yeah. What happens if the business is online and you're selling online?
So that's the tricky question. A lot of people are selling online, and I assume the person is asking about sales tax gets really tricky when you're selling online, because if you're selling to New York customers, actually there's programs now with a lot of the online programs that it figures this all out for you. But if it doesn't, just be aware that if you're selling to people in New York State, you are supposed to be collecting New York State sales tax. If you are selling to people outside of New York State, you may have to collect sales tax for each state you sell in, and or use tax. So it's not an easy answer, and I wish that it was. But there has been a lot of litigation in the courts about this. Every single state has different requirements. Some have a requirement that if you only sell up to a certain amount, you know, a dollar amount, you don't have to file sales tax until you meet a certain threshold. Others have a volume of business, whether or not you're selling a certain volume in a state. So you'd have to know where you're selling, and what their rules are. As far as New York State, you are still required to collect sales tax on items that would be subject to sales tax, whether you sold them online or in a store. So you want to make sure you know that, but there are great programs that do it all for you. As soon as you plug in the delivery address, it tells you who you are paying taxes to, how much to collect and all that. So there are great programs. I would look into that. I wouldn't even try to sell out of the state online without one of those programs. And they're great. They run a report and you have all that data there. And you get that over to your bookkeeper or you do it yourself, and then you're set. I hope that answers your question. I'm not sure. Okay, in New York State, again, same thing with employers. If you have employees, you also have to do the withholding. And there's a form called New York State NYS 45. It's the quarterly combined withholding, wage reporting, and unemployment insurance return. It is where you are reporting the income tax withholding that you've done, and unemployment insurance that gets withheld. It's usually, again, filed online. Like I said, New York State tries to get everyone filing online. It's not impossible to file by paper, but they really, really encourage it online. The due dates are there. This is another one of those forms where if you don't file it, they're going to send you a notice saying that you owe a penalty. And the longer it goes unfiled, the penalty keeps going up. So if you have a reason for not filing, for example, you started having an employee and then you stopped, and they're just looking for it because you filed it for the last 3 quarters. They're going to like, where's your New York State 45? We don't have it. You can call them up or send them a letter and let them know you don't have employees anymore, and usually they'll just remove that penalty for you. Same thing with sales tax. If you forget to file it because you didn't have any tax sales or any sales at all for that matter, you can write to them and tell them I didn't have any sales or I didn't have any taxable sales that period, and they'll probably remove the penalties for you. New York State's easier to deal with in that respect, but most other respects, it's not. IRS is actually easier, believe it or not. New York State's a tough state. Speaking of New York State being a tough state with taxes, they have so many taxes. So you might want to go onto the website and make sure, depending on where you're located, there might also be local taxes, but there are so many different taxes and varieties. I just listed a few here, but there's 20 more on there that we haven't even touched base on. So be aware, make sure you're doing your research, that you're making sure you're reporting all the things that you need to be reporting to the various taxing authorities, because the city of New York also has a tax agency that collects taxes for New York State or New York City, sorry. And so you need to be aware of the differences if you are doing business or your business is located in New York City. Record keeping. I always include this section on record keeping. And again, I'm not trying to scare anybody. I really don't want to scare anybody. I just know that I see so many people get into trouble and their businesses end up getting into trouble because they weren't sure what they needed to keep for records. And so they either didn't file their return at all, file it on time or file it correctly and have issues, or they get audited and they can't back up the information they put on their tax return because they did not keep good records. And so hopefully this prepares you so you know, because again, you're focused on your business, your sort of business plan, your business model, your marketing, your financing, and all of that. You're not necessarily focused on how you're keeping records for tax purposes. And they're a little bit different than what you might keep to make sure people aren't stealing from you, the records you might keep to make sure you're watching your cash flow. These are what you need for if you ever face an audit, or if you have to prove that the numbers on your tax return are right. And so some of the record keeping things, again, the businesses are actually required. There are record keeping penalties you could face as well if you can't provide them with records. More importantly, though, if the records aren't what they call sufficient, it will allow IRS or New York State during an audit to come in and use what they call an alternative method to determine what your sales tax would be or what your income tax would be. So let's take sales tax, for example. There's a restaurant, let's say, and it's a buffet restaurant. And so an auditor comes in, and sometimes they come in sort of secretively. They don't identify themselves. An investigator will come in, they'll sit down in the restaurant, and they're going to count every single person that walked in that day. Of course, they're going to pick the busiest day that they can pick. So they'll pick a Saturday, and a bus just dropped off, it's a tour bus going to Niagara Falls, and they stop and unload 55 people into this restaurant for the buffet, and then they head out. And if every other Saturday normally is kind of quiet, you get, dance moms from the dance studio next door, and that's about it. New York State doesn't care. They're going to use that busload of people on that busiest day that you've ever had, and they're going to extrapolate that out and say, okay, because you had $300 in sales on that Saturday, you have $300 in sales on every Saturday. And in fact, every day, even Monday, even Tuesday, even holidays, even weekends, or, days that you're closed. So they just extrapolate it out. They cannot do that, however, if you have records that are sufficient and available to show clearly and accurately what your sales were that day. So that's why it's really important to keep good records for this. The record keeping requirements, they vary depending on the tax authority that you're dealing with and the type of tax information that's getting reported. But generally, you're going to want to keep your records. And by records, and I'll talk about the details under there, what records. You want to keep them to between 3 to 7 years. Keep them in a safe place. Hope they don't get rained on or flooded in the basement. I try to keep them very safe. If you can keep them electronically and physically, even better. Records should accurately reflect the income and expenses that you have reported on your return. So they're going to come in and they're going to say, show us where you got this gross receipts number. Show us that you really had all these expenses. And you've got to be able to show them invoices and purchase orders and things like that, receipts. Employment records should accurately reflect what's reported on your returns. So if you have your 941s and you file them, but you're paying half of your people under the table, you're going to have issues if they figure that out, that kind of thing. So you want to make sure you can accurately reflect all the employees that you have and how much you paid them and how many hours they worked and what their rate was and things like that. So back in the day, it was time cards. Now it's usually done online. And even if it's just a log, just make sure you keep them. Okay. If people are signing themselves in and out of some sort of log, just keep those records. The records should be made and kept contemporaneous. So if you have mileage logs to show expenses on your travel, it should be done contemporaneously. So every time you get in the car, you write the mileage down and what have you. Sometimes you can make an argument and you can use like a Google Maps, driving directions and recreate it, and they may accept it. But if you can show them a contemporaneous log, they are going to accept it as long as they think it's legitimate business travel. All the records should be made available upon request by the taxing authorities. So they will sometimes send you, if they have questions, they're going to send you what they call an information document request. And they're going to say, listen, we need to see all of your payroll records. And you can't say, I'm sorry, I don't have them. Well, you can, but you can say that, but it won't suffice for them. They will move forward. It's not going to get you out of the audit. You are supposed to, as a business owner, maintain those records for the tax authorities who ask for it. And if you don't make them available, they can assess a penalty to you. But worse than that is what I said before. They're going to go ahead and figure it out on their own, and it's never going to be accurate. And if you don't have records to dispute it, you're stuck with their number, and it's always going to be more than you really would have. So like, for example, sales tax records, you've got to show all your gross sales, all your taxable sales. It's got to be obvious what was taxable, what wasn't. It should show, again, if you're you're selling online and you're delivering out of state or in some different locality, you got to know, because different areas have different sales tax rates. Anything that will show it. So a lot of the times what they are going to ask for is a number ordered invoice of some kind to show. So when you go and you see guest checks at a restaurant, they have a number on them. If you can't turn over every single one of those guest checks with those numbers and or explaining the gaps in it, they will say that those records are insufficient, and they're going to figure out your number for you, I guess. So sales records, same thing. You're supposed to show every sale, the amount paid, charge or due on the transaction, how it was paid, any sales tax that was collected. If you have receipts or invoices from vendors, you go to Office Max or Office Depot, I don't even know what's around anymore, and you buy, a mileage log, and that's an expense. You should have that receipt, those simple things. If you don't have the receipt, sometimes you don't have the records, just means you don't get the deduction. So it's better to keep the receipts for all of your expenses, because that's how you prove that you don't owe tax on that money. Otherwise, they'll just call it income and you don't get the deduction. You're paying extra tax. The auditor should be able to independently determine the taxable status of every transaction, the amount of tax that was due and collected. So they shouldn't have to do guesswork. They shouldn't, it's written in a separate log. They should be able to sit down with your records and figure out exactly what your sales were and what's due over to New York State. Again, delivery records, same thing. If you're delivering out of locality or out of state, you've got to keep records for that. And also your purchase records. You need those to your best. It's for the best if you have these records handy, because those will make a big difference if you can't claim those as deductions. So record keeping for payroll and Department of Labor audits. The records have to be kept in a manner that's going to let IRS and or New York State be able to figure out what the tax liability would be. And they're going to ask for records that include the name, address, and social security number of every one of the employees. They'll want to know how much each of them were paid on what days, the period of service covered by the pay period, the portion of a payment that was of compensation that constituted taxable income. They're withholding exemption certificates if they have them. The dates and the amounts of the tax deposits you made, copies of the returns you filed, and W-2s that weren't delivered. Like if you've sent out your W-2s and they came back as undeliverable, they want that. And the reason this is right here is one of the reasons that I say try to get a payroll company if you have more than a handful of employees, because the payroll companies keep all of these records. They give them to you, but they also have them. And sometimes they're online. It's just a matter of clicking a button and getting it for the taxing authorities if they call and ask for it, or the Department of Labor. So it's important to have good records. The better the records, the better you're going to be. And it also takes a lot of stress off you. Nobody wants to go through an audit. Audits can be very painful, but the reality is that if you have all the records that can support what you put on your return, it's going to be a very easy process for you. And I did have a client one time that had such fantastic records, and they were so neat and they were so organized and in such good shape that the auditor came and spent the day in my office going through boxes and boxes of records. And she left with a smile on her face and said, "Have a good day," and made absolutely no changes, because she could tell just from the organization of the records that she wasn't going to find anything that didn't match up. So sometimes when it looks really good too, they assume that it's good. If they find a mess, they're going to assume that the return is wrong. So, and again, remember, if you hire employees, if you need to hire employees, and hopefully you do, hopefully your business grows and you're able to hire a bunch of people, it just does add another level to your business. And again, you have to have an EIN when you're going to have employees. You have to register with New York State and report certain information to New York State about new hired employees. They keep track of things. They do it for statistical reasons as well. You're probably going to have withhold state, possibly city, or local income taxes and pay it over and remit it to the tax department. That would be on your New York State 45 in New York State, or your 941 to the IRS. You're going to have to carry unemployment insurance. You're going to have to carry workers' compensation and state disability insurance, and you may probably likely be required to make periodic tax deposits. And again, the idea behind that is to make sure you don't get behind with your taxes so that you can't pay when it's really due. I'm trying to watch my time here. I know I don't want to keep you guys too long, and I want to give you a chance to ask questions. So basically, in summary, some important considerations to keep in mind. That taxes, again, obviously can impact your business decisions, and your business decisions may impact your tax obligations, your reporting and paying obligations. So it's really important to kind of keep those two things in line. If you're making business decisions, think about how it's going to impact your tax situations, or if you're making tax decisions, make sure you understand how that may or may not impact your business. You want to keep an eye on your business cash flow, especially when the business starts growing. And one of the things that I see happen a lot is that people think they have cash flow because they haven't set aside their withholding, their sales tax, or their employment taxes in a separate account. And so they start spending it, and then all of a sudden the 941 is due and they can't pay it. And you don't want to get into that situation. So be very cognizant, because what you're watching for tax purposes isn't necessarily what you're watching for cash flow purposes. And again, rely on your team, your accountants, bookkeepers, CPAs, payroll companies, attorneys, consultants. SCORE, what a great resource SCORE is. I mean, they have so many things that you can use. They have templates, they have the sessions with individuals that can answer questions for you, and the website is great. So use your resources as much as possible. Use your New York State websites, your IRS websites, things like that. Again, there can be dangers not paying attention to your cash flow. It represents the lifeline of the business. Positive cash flow is essential to the survival of the business. Sometimes you're purchasing inventory and you get a great deal, and so you're bulking up, and then all of a sudden you're cash poor and you can't make other decisions or pay your taxes. You get behind, it starts to, and then if that inventory doesn't sell, you sort of snowball into a disaster. But another very important thing I would say to every new business owner, when you start a business and the money starts coming in, and if you haven't set up separate accounts or separate credit cards, because in the beginning, I know you're just using your personal credit cards, you're using your personal money to fund the business, to get you ahead, but you really should do whatever you can to not commingle your business and personal funds. It makes it a nightmare when an audit comes. It makes it really hard to prove that money going back and forth isn't income, and instead money that you loan to the business, or the business paying you isn't income to you, instead it's repayment of a loan. And so you want to make sure you're documenting all of that carefully. You don't go using your personal card for business expenses. Don't use your business card for personal expenses, because it will get confusing. IRS will come in and just assume that these are personal expenses. If they see pizza on there, they're not going to assume you bought pizza for your employees because you made them stay and do inventory. They're going to think you just went out for pizza and fed your kids, unless you can prove otherwise. So that's why it's so important not to commingle those personal and business accounts. But also it's going to give you a false representation of your cash flow situation. And the last thing you want to do is get yourself stuck in a situation where you think you have cash and you don't. So again, the link between business tax liability and personal tax liability, generally you are a person is not personally liable for the taxes of the business, but they can be. There are ways for the IRS or New York State to come after you personally for the debts of the tax debts of the business, and that one of them is that trust fund recovery penalty that I explained to you. If you are held personally liable for turning over the sales tax or the withholding tax, just know that they're going to put that penalty. New York State doesn't call it trust fund recovery penalty, but They have the same idea. It's called a responsible person penalty. And when you sign up, especially for sales tax, when you sign up for that certificate of authority, you're going to notice that one of the question is, who's the responsible person? When you put yourself down because you're the only person that owns the business, you're the responsible person. You've just signed yourself up to personal liability if that sales tax doesn't get paid. Just be aware of that. But you have to. It's the only way to get the certificate of authority. But just know that that's what happens. So if you don't pay the sales tax of the business, it's going to sit on your personal account, and they can come after you personally for it. And so you want to make sure that, again, that's part of the reason why you keep good records, part of the reason you don't commingle, part of the reason that you set aside your sales tax money, because you don't want to have to pay it out of your own pocket or lose your house because of it or something like that, which is always what everybody worries about. It doesn't happen as often as you might think, people taking your house, but it can happen. If you owe taxes, and especially if you're personally responsible for the withholding taxes like sales tax or the regular employment taxes, if you are held personally responsible, it shows up on you as an individual as well. And if you are seriously delinquent, and in New York State, seriously delinquent is only $10,000 in tax liabilities. If you owe New York State $10,000 tax liabilities, they can suspend your driver's license. And if that's what you need to get around to conduct business and run your kids to school and everything else, you don't want to be losing your driver's license. Now, you can get a restricted license, and there's a lot of delays you can put into the system before they take your driver's license. So if you get a notice where they are referring you for suspension of driver's license for unpaid taxes, get a tax attorney involved. We can help you. They can help you, not just us. A lot of attorneys do it, but attorneys will help you delay it and hopefully have it not happen. So don't delay on that, because there's a pretty quick turnaround to get 60 days. Same thing though with IRS. IRS is what's the terminology? Seriously delinquent is $50,000 in taxes. If you owe IRS $50,000 in taxes, they can revoke your passport. So keep that in mind, because again, it doesn't take long. If your business is growing and you've got a lot of employees, it would not take long for you to accrue a $50,000 tax liability if you're not paying your 941. So that's why I put that in there. Just make sure you kind of keep it in mind. And as your business grows, of course, your tax issues can get more and more complicated. So always rely on professionals, as much as you can. But at the same time, you should know your business. You should know what's going on. That's why it's important for you to sort of know what you might have to file for taxes so that you're asking the right questions. It's important for you to know what records to keep. Some accountants aren't going to tell you. They're not going to advise you on those things. So make sure you also know your business and what's taxable and what's not, and how to keep your records, and when it's a good idea to get employees and when it's not. Obviously rely on them, but also know your business. And again, the other resources here on the back page. So tax.newyork.gov for the New York State Department of Tax and Finance, and IRS.gov. They do have really good information in those websites. So it is a great resource for you as well. And now I am open to questions. And if I can't help you, again, I can get back to you if you call me or text me your question, and or point you in the right direction if I don't know the answer.
Oh, that was a lot of information, Tiffany. Thank you. Any more questions in the chat room? I'm not seeing any yet. Yeah. Yeah, I think what's so wise is for anyone that's in a business, starting a business, is make sure you have your team, have an accountant, have an attorney. You might not need to use them all the time, but it is nice to have the people that you already know are there to help you with these issues, because it can get very complicated.
Yep, absolutely. And a lot of times, obviously, when you're starting a business, usually you don't have a lot of funds floating around. And so people tend to think that they don't want to take on the extra expense of hiring an accounting firm, a CPA, or an attorney. But sometimes that money up front helps save you a lot of money on the back end. So just kind of keep that in mind. It is an important business expense, and it's also deductible.
That's right. That's right. All right. Well, I'm not seeing any other questions. So again, I want to thank you, Tiffany, for your time and your expertise. This was a really important and full of knowledge presentation. So thank you very much. And
You're
again,
very
we will be
welcome. Good
sending
luck,
out the slides tomorrow.
All right,
Okay.
take care.
Oh,
Thanks, Nancy,
thank
for
you.
filling in. All right.
Yeah,
Bye.
you're welcome. Okay, bye now.